Hello, this is Jeff McDermott with Create Wealth Financial Planning. I'm here today to share with you kind of a niche tax strategy called bunching tax deductions, specifically as it applies to your property taxes today. This is a strategy that is certainly not going to be for everyone. It's definitely something you're going to want to talk to your tax professional about first. Remember, I'm not an accountant, I'm a financial planner. We look at things at a high level, look for opportunities, and we can work with your CPA to dig in and make sure the actual numbers check out. And this particular strategy comes up because the tax legislation passed in 2025, the One Big Beautiful Bill Act, has removed the $10,000 cap or limit on state and local tax deductions, which includes property tax, and has replaced that with a $40,000 cap through 2029. So what this means is I think you've got some opportunity to potentially revisit a tax planning strategy to maximize use of this deduction, especially because the standard deduction that you get just for showing up is still pretty high, approximately between $15,000 and $32,000, depending on your tax filing status. So the standard deduction being so high can take a lot of the sizzle out of things like the mortgage interest deduction, state and local tax deductions, charitable giving deductions, because the first $31,500, if you're married, is automatic. And a lot of us just wind up using the standard deduction because of that. This might help you break through that threshold. The idea here is that if you are either, the idea here is either pushing a property tax payment into the next calendar year or pulling a payment into the current calendar year so you can maximize itemization in one year and still take that standard deduction in the following year and alternate between the two. Again, it's not going to be for everybody. Obviously, you have to own a home for this to work, but it's an example of opportunities we try to look for in financial planning to see if they fit. Let's walk through one scenario here, see what it might look like, and then talk about who can and should actually be thinking about taking advantage of this. So here's a scenario. Let's call it a married couple that has two children. Let's say they live in a place like Texas that has no state income tax but has relatively high property taxes. This is a tax planning software I use called Holistaplan. It's great. It lets me run through some scenarios like this at a high level. So let's say this family has $300,000 in income. We're going to look at two scenarios with two different years. Over here on the left, the standard scenario of just paying your property taxes in each year that they are due. And over here on the right, bunching those property taxes into one year. So first off, focusing on these two columns on the left, adjusted gross income of $300,000, state sales tax deduction because there's no income tax. The IRS website says someone living in Texas with $300,000 income might have about $2,800 to deduct there. And then real estate tax or property tax. A $700,000 or $800,000 home probably has at least a $12,000 a year tax bill. So we're going to itemize that in each year, or we're going to put it in the calculation. See, the way this works is you add up your itemized deductions and see which is bigger, the itemized total or the standard deduction. This gets us to $14,800 in tax itemization. Remember that was capped at $10,000 in previous years, so we're able to use a little bit more of that this year. And let's say they still have a mortgage and they've got about $10,000 in mortgage interest. Maybe they've been paying on it for a while, but again, still working through it. So with that $10,000 interest expense, let's say they do $5,000 in charitable giving. That actually gets adjusted in future years based on some tax law, but that's applied equally in both scenarios. We get down to our optimal deduction for this year, and because the itemized deductions only add up to about $29,800, we wind up with our standard deduction. Our optimal deduction is the standard deduction in both years. So $31,500 this year, $32,000 approximately the expectation for future years. Okay, that means we've got about $46,000 tax due in the first year and about $45,000 tax due in the second year. Let's look at the scenario if we bunch those property tax deductions into a single year. So let's say that we get both of our property taxes paid in 2025. We've got the same sales tax deductions in both years, but $24,000 in property tax deduction in the first year, no property tax deduction in the second year. That's okay, because we're going to see what happens. That takes our state and local tax deductions up to $26,800 in this example. Again, remember that was capped at $10,000 previously. Now they can go all the way up to $40,000. Again, no extras here in this year. We have the mortgage interest deduction for each year. How's that all shake out? Well, in the first year, our optimal deduction is the itemized deduction because that adds up to over $41,000. in this year. Optimal deduction in the second year is still that standard deduction. That's the same as the first scenario. So you see in 1 year, we have almost 10,000, we have over 10,000 more in deductions. The second year, it's exactly the same. At a 24% tax rate for this household, what that translates into is about $2,400 less in taxes in that first year and the same in the second year. It's a lot to look at across these columns, so let's just kind of bring it all together. You've got, in the first scenario, paying the taxes each year that they're due, about $63,000 in total deductions at about $91,000 in total taxes. When we bunch that property tax into 1 year, it's an extra $10,000 in deductions in this scenario, which is an extra $2,400 in tax savings in this scenario. Okay, so great opportunity just by moving the date that you write a check to save quite a bit on property taxes, or on taxes as a whole, I should say. Who can actually make this work though? Because again, number one, you've got to actually own a home for this to work, because you've got to have that property tax bill, and you have to be paying your taxes outside of escrow. Shout out to my friend here in Jacksonville, Lee Siminoff, who is a mortgage broker here and helped me talk through how some of this works when you are escrowing your taxes versus not. Your mortgage company, if you're escrowing your taxes, is not going to let you do this. So some folks just aren't going to be able to do it because, yes, the mortgage company might require the escrow. Or it may just not be a good idea for you to try to get out of that escrow if you don't have the discipline or the cash flow to make sure you're keeping up with that property tax payment. That's not to be taken lightly. It's like telling somebody to charge everything on a credit card and just pay it off at the end of the month. Are you going to pay it off when it's due? So don't lose your home just over a little tax strategy like this. But if your home mortgage is paid off and you have to pay your property tax out of pocket because you don't escrow, you could look at this. Or if you are able to avoid the escrow, get out of it, and you have the discipline and the cash flow to keep up with this, it's something that you could take a look at, right? Again, don't be late on your property tax payment. Don't, risk losing your home over a couple $1,000s in tax deduction. If you get out of the escrow and you try to get back in, that could be very expensive if you have to pre-fund that escrow account. So don't take this lightly, but if you're already paying your taxes outside of escrow, definitely something you should at least ask, hey, does this work for me? Other things where, this might maximize the value of this. If you're in a high property tax state, like I use Texas as an example, it's all the more that you could potentially double up on in a given year. If you're in a high income tax state, again, you've got up to $40,000 that you can use in potential deduction. So maybe you have a combination of the two and it hits that sweet spot above the standard deduction, but below that $40,000 cap. Take a look at the numbers. It's great for high income folks, but if your income's too high, it's actually not going to work for you because there is a phase out from $500,000 to $600,000 in income where you're going to wind up right back at that $10,000 cap. And again, it takes a lot of the steam out of this. And we looked at a married filing scenario, but if you're a single filer, again, there might even be more value because you have that lower standard deduction. That's half of what the married filing deduction is. And the range, the phase out still is up at $40,000, and the phase out of the deduction doesn't start until $500,000. So again, there's some extra room there maybe for a single filer. So look at your situation, talk with your tax preparer, see if this is something that would work for you. Don't risk your house on the strategy if you're not the kind of person who should be paying property tax out of pocket. But if you already are, or you have the opportunity to do that, take a look at this strategy to try to maximize your deductions. Reach out to me with any additional questions, comments, subscribe to the channel for more videos like this, and let me know if there's anything else you would like to hear me talk about. Thanks.